Welcome to the Deep Dive. Today we're tackling Navitas Semiconductor, ticker NVTS. It's a really interesting small cap player right at the heart of some huge trends: EVs, AI data centers, clean energy, the whole electrification revolution. As of September 27th, 2025, the share price is sitting at $6.43.
And that $6.43 price point, well, that's really the crux of it, isn't it? Because Navitas is a classic conflict story for investors. You've got this potentially game-changing technology, this huge future opportunity, but then you look at the books, deep unprofitability, and maybe more worrying right now, shrinking revenue. So the question for you, the listener, is this. Is that share price, which we'll see is right at the top end of its value range, actually paying for that revolutionary future? Or are you basically buying a dream that's, well, already fully priced in with almost no safety net?
Okay, yeah, that's the tension we need to unpack. So we've structured this deep dive into two main parts for you. First, we'll dig into the fundamentals. That means the business itself, the management team, especially with the recent changes, and, of course, those challenging financials. Then, in part two, we'll shift to look at what the market thinks, who actually owns the stock, the big risks you need to be aware of, and then wrap it up with our conclusion. All right, let's get started with Chapter 1, Business Understanding. So, Navitas operates using what's called a fabless model.
Right. Fabless, meaning they design the chips, these proprietary power ICs, but they don't actually manufacture them. They outsource that.
Which keeps their capital spending low. That's the upside.
Exactly. Less need for expensive factories, but the downside is dependence. They rely on third-party foundries, and they don't have the manufacturing scale of the big guys.
Okay, so their value really comes from the design, the intellectual property. What are their key products?
Two main lines. Based on different semiconductor materials. You need to understand both. First, there's GaNFast power ICs. That's gallium nitride, or GaN. Think lower voltage, super fast applications, primarily consumer stuff like mobile phone chargers. Their pitch is charge 3 times faster, half the size and weight, plus 40% energy savings. Pretty compelling for consumer electronics.
And the second line?
That's GeneSiC devices.
Right.
This uses silicon carbide, or SiA. SiA handles much higher power and voltage, so think bigger things. Electric vehicle powertrains, solar power inverters, industrial motors. GaN is maybe your pocket charger. SiGe is powering the car itself.
Got it. GaN for fast charging, SiHeco for the heavy lifting. Now, you mentioned their design is key. What's the special sauce there? Their moat.
Yeah, this is important. It's not just about using GaN or SiC. Their big innovation is monolithic integration.
Monolithic integration, meaning?
Meaning they combine multiple functions, the power switching transistor, the driver circuit, control logic, protection features, all onto one single chip. Instead of assembling lots of separate little components, it's one integrated building block, like a digital in, power out solution.
Ah, okay. And that gives them an edge.
A significant edge, they argue. It simplifies design for their customers, improves performance, saves space, and it's protected by, last count, over 300 patents, either issued or pending. And look, the market trends are definitely blowing in their direction. AI data centers needing more power efficiency, EVs taking off, renewable energy expanding. The projected growth rates are huge. Gun market CAGR, potentially up to 27.4%. CSE, even higher, maybe 32.6%. Massive tailwinds.
But it's not just smooth sailing. Competition.
Oh, yeah. They're David against several Goliaths. Think Infineon, Texas Instruments, huge companies with massive scale and resources. That lack of scale is Navitas' Achilles heel right now. It hits their pricing power, squeezes their margins. That strategic partnership they announced with PowerChip, moving to bigger 200-millimeter wafers, that's a direct attempt to start closing that scale gap. But it's a big hill to climb.
Okay, that gives us a good picture of the business and the tech. Let's shift to the people leading the charge. Chapter 2, Management Evaluation. And the big news here was the leadership change back in August 2025. Co-founder Gene Sheridan stepped down as CEO.
Right, and Chris Alexander stepped in. And this wasn't just swapping out figureheads. It signals a real strategic pivot.
Why Alexander? What does he bring?
Experience, lots of it. Over 25 years in the semiconductor industry, working for the big players TI, NXP, Renesas. Crucially, his most recent role was leading a $2.5 billion power management division at Renesas. And what did he do there? He pivoted that division towards cloud, automotive, and industrial markets.
The exact high-power, high-value markets Navitas needs to capture with its CNE technology.
Precisely. It's a perfect alignment of experience with their new strategic direction. Plus, he has hands-on experience integrating a GaN competitor, Transform, which Renesas acquired. That suggests he knows how to handle M&A and execution in this space.
And speaking of M&A, their strategy seems pretty aggressive on that front too. Capital allocation is all about growth.
Absolutely. It's a classic buy and build approach. They bought GeneSiC to get that crucial CNE platform instantly. They acquired Halo Microelectronics to bring controller technology in-house, vertically integrating. It's all geared towards scaling up and broadening their portfolio quickly.
But that kind of growth costs money. Where's it coming from?
Not from profits, that's for sure, and not from debt, really. It's coming from shareholders. No dividends, no share buybacks. Instead, they just issued 20 million new shares in the second quarter of 2025, raised nearly $100 million.
Ouch. Significant dilution for existing shareholders.
Significant dilution. And it underscores the financial reality here. They are burning cash to fund this growth strategy. And look at the value creation metric, or rather, value destruction. Return on invested capital, ROIC, for fiscal year 2024 was a staggering negative minus a 42.9%.
Minus 42.9%.
Yeah. That number tells you, in stark terms, the company is currently destroying capital. It's placing an enormous bet that future growth and profitability will eventually justify today's heavy investment and cash burn.
Okay, that negative ROIC is a perfect transition into the numbers. Let's dive into Chapter 3. Financial analysis. You mentioned the balance sheet earlier. It seems like a bright spot.
It is. Paradoxically, given the profitability issues, their balance sheet is actually quite strong, what you might call a fortress balance sheet, relatively speaking. They have very little debt. The debt-to-equity ratio is negligible, like 0.02, and their liquidity is exceptionally high, a current ratio of 8.23. That means they have plenty of short-term assets to cover short-term liabilities. They have financial flexibility, runway.
Which they absolutely need, given the rest of the financial picture, starting with revenue.
Exactly. That strong balance sheet is crucial because the revenue trend is frankly alarming right now. If you look back a couple of years, they had explosive growth over 100% in 2021 and 2023, but then things slowed dramatically. Growth was under 5% in 2024. But the really critical number, the one flashing red, is the trailing 12-month revenue. It shows a 25.7% decline, out to $68.17 million.
A 25% drop in revenue for a company whose entire story is built on growth.
Yes, that's the core problem in their current financial narrative. How do you justify a premium valuation when your top line is shrinking that fast?
And I assume that flows straight down to profitability.
Oh, absolutely. The profitability metrics are brutal. Operating margin is negative an aggregate of 164.6%. Net margin, even worse, negative an aggregate of 182.6%. They are nowhere near profitability. And if you look specifically at the second quarter of 2025, their GAAP gross margin actually collapsed to just 16%.
16%? That's incredibly low for a tech company, isn't it?
Yeah.
What does that signal?
It signals intense pressure. Either they're having trouble with manufacturing costs, or they lack pricing power against competitors, or likely a combination of both. They just don't have the scale yet to command better margins.
Okay, so revenue declining, margins collapsing. That must mean they're burning through cash.
Consistently and increasingly. Free cash flow has been negative year after year. In 2024, the burn reached negative $65.6 million, which, as we said, explains perfectly why they had to go back to the market and raise that nearly $100 million through selling more shares earlier this year. They needed the cash infusion.
So how on earth do you value a company like this? With negative earnings, negative cash flow, shrinking revenue, PE ratio is obviously useless.
Completely useless. You have to look at price to sales, or PS, and this is where the disconnect becomes really stark. Navitas is trading at a PS multiple somewhere between 17.8x and 20.1x.
17 to 20 times sales. What's typical for the semiconductor industry?
The industry average PS is around 4.7x.
So they're trading at roughly 4 times the industry average PS ratio, while their revenue is shrinking by 25%.
That's the situation. The market is placing an absolutely enormous premium on the potential future growth, seemingly ignoring the very difficult current reality.
That massive valuation premium really sets the stage for the next part of our discussion, doesn't it? It's all about market perception versus reality.
It leads us right into it. The price is the sentiment in many ways.
All right, let's shift gears then. We've laid out the fundamentals, the tech, the management pivot, the tough financials. Now let's look at how the market is digesting all this. Who owns the shares, the risks, and where we land.
Okay, jumping into Chapter 4, Market Sentiment. Given that valuation, I guess it's no surprise Wall Street is divided.
Completely split. The consensus rating has drifted towards hold or neutral, but underneath that, the analysts' price targets are all over the map. We're seeing targets as low as $3 per share, extremely bearish, and as high as $8. That's a huge range, reflecting the uncertainty.
So a real battleground stock. What are the competing stories? Exactly. It's a battleground. The bulls are clinging to the long-term vision. They focus on the strategic partnerships, especially the hype around working with NVIDIA for AI data centers. That's the big, sexy growth story. The bears, on the other hand, are focused squarely on the recent results. The Q2 earnings miss, the weak forward guidance, and of course that sky-high valuation we just talked about.
Can we quantify the negativity? Is there a measure of bearishness?
Oh, absolutely. You look at the short interest, that's the percentage of shares being borrowed and sold short by investors betting the price will fall. For Navitas, it's extremely high. Depending on the source, it's somewhere between 25.6% and 26.5% of the public float.
Wow, over a quarter of the available shares are shorted. That's a huge bet against the company.
It's a very significant level of short interest. It tells you there's a large, committed group of market participants who strongly believe the stock is overvalued and likely to decline.
What about the technical picture? How's the stock chart looking?
It's a mixed signal, really. Short-term momentum is negative. The stock is currently trading below its 50-day moving average, which was around $6.78. That's typically a bearish sign. However, looking longer term, it's still holding above its 200-day moving average, which is down near $4.42. So the primary uptrend, technically speaking, is still intact, suggesting some underlying belief in the long-term story persists.
Okay, interesting mix of signals there. Now let's look inside the company. Chapter 5. Ownership structure. Who holds the shares?
Well, institutional ownership is fairly high, somewhere in the 40% to 44% range, but a lot of that is passive index funds, Vanguard, BlackRock. They hold it because it's part of certain indexes, not necessarily because they're making an active bullish bet.
So we need to look at the insiders, the people who know the company best.
Exactly, and this is where we see, arguably, another major red flag. Insider activity. Now, overall insider ownership is actually quite high, maybe 13% to 26%, depending on how you count options. That can be a good sign, aligning management with shareholders. But the recent transactions tell a different story. Over the last 3 months, there's been heavy, broad-based selling by insiders. Multiple executives and directors selling significant chunks of stock, including several large sales just this month, September 2025.
So even as the market keeps the price relatively high, the people inside the company are selling.
That's what the data shows. It's not just one person. It's a pattern across multiple insiders. It suggests that those closest to the business, the ones with the deepest insight, might be skeptical about the current valuation or the near-term prospects, or taking some chips off the table.
That insider selling adds another layer of caution. Okay, let's consolidate all this as we move to Chapter 6. Risk assessment. Let's quickly recap the opportunities before hitting the risks. Massive potential markets, AI, EV, renewables, and a new, experienced CEO focused on capturing the high-value segments.
Right, those are the tailwinds. The potential is undeniable. But the weaknesses, the risks, are substantial. We've talked about the execution risk, the chronic unprofitability, the struggle to achieve scale, the intense competition from much larger, better-funded rivals. These are significant hurdles. But there's one more risk, a big one, that we haven't stressed enough. Geopolitical risk.
Geopolitics. How does that specifically hit Navitas?
Directly and materially. Management themselves have highlighted this. They've explicitly mentioned concerns about potential new U.S. tariffs on Chinese imports coming possibly in 2025. Why is this so critical for Navitas? Because in the second quarter of 2025, China accounted for 62% of their total revenue.
62%. Wow. Nearly 2/3 of their sales come from China.
62%. That level of concentration in a single country, especially one that's currently in the middle of significant trade tensions with the U.S., represents a huge vulnerability. Any major disruption in U.S.-China trade could have an immediate and severe impact on their top line. It's an existential threat, almost.
Okay, that China exposure is a massive risk factor to add to the list. So let's try to pull all these threads together. Time for Chapter 7. Conclusion.
Yeah, let's synthesize this. It really boils down to the classic bull versus bear standoff.
Okay, give us the bull case in a nutshell.
The bull case is they have superior patented technology in high-growth markets. They have huge secular tailwinds behind them. They have a strong balance sheet, lots of cash, almost no debt, which buys them time. And they have experienced new leadership focused on the right strategies scaling up in high-power markets.
The bear case.
The bear case is grounded in today's reality. Revenue isn't growing, it's shrinking rapidly. They're burning through cash at an alarming rate. The valuation, that PS ratio, is incredibly stretched, especially compared to peers. Short sellers are heavily involved, betting against them, And crucially, insiders are selling their shares, plus that huge China risk hanging over everything.
So when you plug all that into valuation models, like a discounted cash flow analysis, acknowledging it's very tricky with unprofitable companies, where does the intrinsic value estimate land?
Right, DCF is tough here, very sensitive to future assumptions. But based on reasonable inputs reflecting both the potential and the risks, the estimated intrinsic value range comes out somewhere between $2.44 and $6.74 per share.
Okay, $2.44 on the low end, $6.74 on the high end. And the current share price, again, is...
$6.43 as of our recording date.
So the stock is trading right at the absolute top of that estimated fair value range.
Exactly. Which brings us to the final implication for you, the listener. At $6.43, you are paying a full price, arguably a premium price, that already incorporates much of the optimistic future growth scenario. There appears to be very little, if any, margin of safety baked in to protect you against all those significant risks we discussed, the execution risk, the competition, the cash burn, and particularly that big geopolitical risk related to China.
So a high wire act, essentially.
Very much so. Which leads me to a final provocative thought for you to mull over. Given that heavy reliance on China for 62% of revenue, and the major strategic pivot they're attempting under new leadership, what specific event, maybe a competitor makes a breakthrough, maybe those tariffs hit harder than expected, maybe execution falters, what could trigger the market to suddenly lose faith in that growth story? What could cause that premium valuation to evaporate, potentially sending the stock price down towards that lower end of the value range, closer to $2.44? Something to think about.
A sobering thought indeed. That wraps up our deep dive into Navitas Semiconductor, a fascinating company facing a critical juncture. We hope this analysis helps you think through the complexities. And if you found this deep dive useful, please do like and subscribe to Stock Analytics AI. It really helps us out. Remember, for €4.99 a month, members get priority access to our deep dives, including our upcoming coverage of all S&P 500 stocks. Plus, you get exclusive priority access to our research pipeline. If you just want a one-off deep dive on a specific stock you're interested in, like this one, please consider dropping us a super thanks.
And the important reminder, this analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.